Hey guys, thanks for joining this evening on our first workshop for how we could help folks and learn more about the current and future state of borrowing for your education. And I want to thank Assemblymember Catalina Cruz, Jessica Gonzalez Rojas, of course, Nancy from EDCAP on a very important resource. When I was in need of this, it was very hard to get that information for higher education. But it's so wonderful to have this information to better understand the financial aid process in New York, the new borrowing rules for FAFSA and available aid options. And so today we're going to go over the new era of student loans, what current and future borrowers need to know, and hopefully you guys can get a lot of wealthy information from it and also join us again for part two. So I just want to hand it off again to Assemblymember Catalina Cruz.
Thank you, Steve. Thank you, everyone. I want to make sure that I get an opportunity to thank my colleagues, Assembly Member Jessica Gonzalez Rojas and Stephen Raga, for their coordination with our office of this great event. As we get into the process of students getting their answers from colleges, there's going to be a lot of questions on what happens after that. All right, you got into school, how are you going to pay for it? And this is a great opportunity for parents and families to learn more about it. I want to welcome everyone. We represent neighboring districts, Jessica Gonzalez Rojas, Stephen Raga, and I. We share many students. Some live in my district and go to high school in one of theirs, and vice versa. So we have a shared interest in making sure that students are getting the information they need. My colleague, oh, there she is, Jessica Gonzalez Rojas is with us now. Jessica, go ahead and introduce yourself because then I have to introduce Nancy.
Wonderful. Thank you, Assemblymember Cruz. It's an honor to join you as we're fighting for our neighbors who are students. Many of us have personally experienced being saddled with debt, and EDCAP has been a vital service for so many in our community. And we've done this webinar, I think, year after year together. So thank you, Assemblymember Cruz. My name is Assemblymember Jessica Gonzalez Rojas. I use she, her, pronouns. Again, we're just really thrilled to be able to partner with EDCAP to provide vital resources and information to navigate your student loan debt. I want to thank the whole team, and you're in for a treat with the really great presentation that they'll provide. And we're just thrilled to be here. So I don't want to spend too much time. I want to make sure we get right into the work. But thank you, Assemblymember Cruz, for pulling us together to do this together, provide this important resource to our community.
Thank you so much.
Yeah.
And folks, we're actually up in Albany now, and that's one of the reasons we're doing this by Zoom. So if you get an opportunity, I think our team is probably going to be able to upload this onto Facebook so that they can share it because these items are recorded, these workshops. We want to make sure that we're sharing it with as many people as possible. And with that, I want to introduce Nancy Neerman. She is the Assistant Director of EDCAP, which is the Education Debt Consumer Assistance Program. She joined shortly after the launch in 2019, and she has extensive experience in counseling borrowers in all aspects of federal student loan system. Now with the changes, she's going to be able to tell us a lot about that. She currently manages the network of the EDCAP group of community-based organizations located throughout New York State. And so with that, we welcome you to our workshop, and we look forward to hearing more information. We're going to get off the screen because we have to go back to Democratic Conference. We're in the middle of the beginnings of budget negotiation, which we hope will mean a lot of money for a lot of students. Thank you, Nancy. Bye,
Thank
everyone.
you. Thank you so much. Thank you, Catalina Cruz, Assemblymember Jessica Gonzalez Rojas, and Assemblymember Stephen Raga, and all the constituents for coming out on in an evening to listen to this. So I'm just going to do a little bit of housekeeping before we start the presentation. Um, as Assemblymember Cruz said, this presentation will be recorded, and everybody that registered and attended will get a copy of the recording and a copy of the deck. We'll email that to you over the next couple of days. If you have any questions, feel free to type them into the Q&A box. We don't use the chat during these webinars, so type them into the Q&A box. I'm operating solo here, so I will break periodically to look at the questions. And if we have time at the end, we just may open it up to allow people to unmute. So with that, I am going to actually take myself off the screen and we will share the screen and get started. Okay, so hopefully you should all be able to see the presentation. And Evelyn, if you can just confirm that you can see this, I'd appreciate it.
Yes.
Okay, great. So we're going to be talking about a lot of things tonight. It's going to be a lot of information coming your way, but I wanted to start out with a little bit of information about our program, the Education Debt Assistance Program, or EDCAP. We're a program of the Community Service Society, or CSS. CSS is a nonprofit organization, longstanding in New York City, has been operating for over 180 years. They created the EDCAP program in 2019 specifically to deal with the issue of student debt. Number one, because it's a huge issue financially. It's the second largest consumer debt in the country next to mortgages, totaling in the nation about $1.7 trillion. In New York State, there are about 2.5 million borrowers that carry close to $100 billion worth of debt. We are New York State funded, which allows us to offer these workshops and educational opportunities for free. In addition to that, we provide one-on-one counseling. So if you're getting overwhelmed with everything that you're hearing tonight, everybody's got a different situation, and you want individual help, you can reach out to our office, and we have contact information at the end of the presentation to get a one-on-one consultation, and we'll give you a free, tailored hour or so to go over your student loans. And by the way, you're not limited to just one meeting. If you need follow-up, you can have as many follow-up meetings as is necessary and they're all for free, to resolve any issue that you may have. Okay, so let's get right into it. As many of you probably know, the new budget bill that was introduced last year on July 4th is going to bring some very sweeping changes to the federal student loan system. So we're going to go through all these changes, the ones that are most pertinent to people that I think that they're most concerned about. And we're going to start with borrowing limits. So these borrowing limits are going to go into effect on July 1st of this year. Starting with borrowing for undergraduate degrees, that's direct subsidized and unsubsidized loans. There actually is no change to the limits for borrowing for undergraduate school. Right now, if you're a dependent undergraduate, you can borrow, the range of borrowing limits is from $5,500 a year up to $7,500 a year, with no more than $31,000 in aggregate as a student to satisfy your undergraduate school needs. If you're an independent student, and there's different definitions of that, you can borrow between, I think, $9,500 and $12,500 per year, up to $57,500. So there's no changes to those limits. The changes really start when it comes to borrowing for graduate school. So direct unsubsidized loans for a master's degree, the borrowing limit is $20,000, $20,500 annually. That actually has not changed, but there is now a lifetime limit on borrowing unsubsidized loans of $100,000. That's over and above what you take out for your undergraduate degree. Now, if you're pursuing a professional degree, and I'm going to go into a little bit more detail what defines a professional degree, but it's mainly degrees for law and medical schools. The annual limit is $50,000 and the lifetime limit is now $200,000. There didn't used to be that differentiation, and that's because of something called the PLUS loan, the Graduate PLUS Loan Program. So with the Graduate PLUS Loan Program, if there was a shortfall and your borrowing of unsubsidized loans didn't cover the cost of attendance, under the Graduate Plus Loan Program, you could borrow up to the cost of attendance and fund your entire graduate degree within the federal student loan system, which of course has its advantages. This program is being phased out. It's going to be phased out starting July 1st of 2026, or if you're a new borrower starting July 1st of 2026, there will be no more Graduate Plus program. In order to complete your master's degree or your professional degree, you're going to have to be um, you're going to have to go to a school that falls within these total lifetime limits. And if your school is costing more than that, which very often for some of these more expensive degrees they do, you're going to have to find alternative forms of funding. Some either go to private resources, family resources that you may have, or private loans, which is, um, needless to say, can be difficult to get, number one, and also difficult to pay off. For Parent Plus loans, the concept was similar. For Parent Plus loans, these loans are available to parents of dependent undergraduate students, and they're only to help borrowing for undergraduate degrees. So you can't borrow a Parent Plus loan to finance a graduate program. They are not eliminating the Parent Plus loan, but in the past, like I said, you were able to borrow up to the cost of attendance. So that's the gap between the total cost of attendance minus whatever aid the student received in direct subsidized and unsubsidized loans. Now there's going to be an annual $20,000 limit per child and a lifetime limit of $65,000 per child. And that they're going to look at the borrowing between two parents in order to come up with that limit. So it's vastly changing the landscape under which borrowers are going to be able to fund their degrees going forward. Now, there is a grandfathering clause for these plus loan programs, both graduate and Parent Plus. And what the grandfathering clause does is if the student has a direct loan that was dispersed before July 1st of 2026, the graduate students and the parents can borrow under the existing rules. So that means they can borrow up to the cost of attendance for a maximum of 3 years until that, or whichever comes faster, either up to 3 years for that student to complete their program of study. So basically what that means is if you're in a professional degree program and you're pursuing a medical degree and you've already got a loan dispersed prior to July 1st of 2026 for that particular degree, and there's no breaks in you pursuing that degree, you can continue to borrow under the Graduate Plus program until you finish that degree, but for no more than 3 years. The key thing to know, though, is even though you will be grandfathered under the old borrowing rules, you're going to have to pay the loans back under the new payment rules. And that is going to be particularly an issue for Parent Plus borrowers, and we'll talk more about that in a second. Okay, so these are the degrees that are considered to be professional degrees under these new rules, and that will allow you to borrow more within the federal system for you to complete the degree. So the lifetime limit for these degrees is $200,000. And as you can see, for the most part, there are different forms of medical degrees. There's law degree, there's clinical psychology, which they added at the very end of the discussions, and there's also a theology or Master's of Divinity degree that qualifies here. There are a limited number of additional degrees defined as professional using some broader definition that they came up with. However, some of the most notable absences from what's defined as professional degrees would be anything that pertains to nursing. So nurse practitioners, physician's assistants, accounting degrees, social workers, Masters of Education, those are all going to be under the new $100,000 lifetime limit rule. All right, so let's talk a little bit about repayment options. So I just want to touch a little bit on the SAVE plan. I think probably a lot of you are familiar with the SAVE plan. The SAVE plan was a repayment plan that was introduced by the Biden administration that was going to be, for the vast majority of borrowers, the cheapest available repayment plan out there. And as a result, when it was introduced in late 2023, some 8 million borrowers enrolled in the plan. Shortly thereafter, there were court challenges, and as most of you know, if you were in the SAVE plan in July of 2024, you wound up being placed in a forbearance because the courts basically put an injunction on the Department of Education, preventing them from enrolling new borrowers in the SAVE plan or calculating payments in that plan. So we've been in kind of this legal limbo since July of 2024, waiting for this case to be resolved in the courts. In the last couple of months, the Department of Education and the plaintiff in the case, which was the state of Missouri, reached a settlement proposal that will end the SAVE plan. Now, the SAVE plan was going to end as a result of the new budget bill anyway, but not until 2028. This settlement is going to end the SAVE plan earlier, probably sometime this year. However, the proposal has not been approved by the courts yet. It still has to go through that process. Once that happens, we don't know exactly when that happens, but we do expect it to happen within the coming months. The Department of Education is going to notify borrowers who are affected, who are still in that SAVE forbearance, of the timeline for exiting that SAVE forbearance. And they've indicated that they're not going to stretch that timeline out too far, but we have to wait and see what they actually come up with. Now, that doesn't mean that you have to get out of the SAVE plan right now if you're in it, or out of the SAVE forbearance. However, you should be aware of the fact that, number one, interest is continuing to accrue, and no credit is being earned towards forgiveness while you're in the SAVE forbearance. If if you don't choose a new plan by the time they tell you that you have to get out of the SAVE plan, then they're going to place you in a standard repayment plan, which in a lot of cases can be more expensive than what you would be getting in an income-driven repayment plan. But if that happens, don't worry, because you will still have an opportunity. You can still file an application and eventually get into a plan that's based on your income. And just a tip, if you're wanting to get a sense of what your payment might look like if you did switch out of the SAVE plan right now and what it might look like in another plan, you can actually run the IDR application from your federal student aid account. You can start the application. If they're able to link to the IRS database to get your income, you're going to get some immediate estimates in the plans that you're going to be eligible for and what the payments are likely to be. And you don't have to submit the application to see that. You could just start the application. If you don't want to submit it, you just exit before you click the sign off button. Okay, so what are the repayment plans for future borrowers? So borrowers taking out new loans or consolidating existing loans on or after July 1st of 2026 are only going to have one or two repayment options. So one of those repayment options is going to be a new tiered standard fixed repayment plan. So right now, people have access to what we call traditional plans, where the payments are based on income and interest rates and payback periods, kind of like paying back a regular consumer debt, like a mortgage or a car loan. That is going to be available to student and Parent Plus borrowers. The payback period is going to range from 10 to 25 years, and it's going to be based on the size of the debt. Then there's going to be only one income-driven repayment plan, the plans that are based on your income. It's called the Repayment Assistance Plan, or RAP. That is only going to be available to student borrowers with direct loans. So new Parent Plus borrowers are not going to have any access to the new IDR plan. In fact, they're not going to have access to any IDR plan. They're going to have to pay all their loans back in the standard fixed repayment plan. And we're going to talk more about that in a minute. The way the RAP plan is calculated, it's a little bit different from the current income-driven repayment plans. It's going to be based on 1 to 10% of your adjusted gross income for income above $10,000 or more. The payment would be reduced by $50 for each dependent child that you claim on your tax return. So that's actually a less generous treatment of family size and dependents than you have with the existing plans. There is going to be a minimum payment of $10, and that's regardless of your income. Under the current plans, if your income falls below a certain level or you have no income, you can actually get on a $0 repayment plan. Under these new rules in the RAP plan, the minimum payment is going to be $10. On the plus side, there are some good aspects of the RAP plan. Unpaid interest is not going to accrue to your accounts. So if your payment is not large enough to cover the interest that accumulates on your account every month, the unpaid interest that you're not able to cover is no longer going to be added to your account balance, which is what you see now on the existing plans, which is what makes people's loan balances balloon, even though they're making payments every month. And it's very disconcerting to see that and frustrating. So that's not going to happen under the new WRAP plan. In addition to that, as long as you're making whatever required payment you're asked to make, if that payment is not enough to pay your principal down by $50 a month, then the government is going to pay it down by up to $50 a month. So as long as you're making the payment, if the required payment is only $10 a month, as long as you make it and you make it on time, not only will you not see your loan balance increase, you'll actually see the balance go down every year. Another good aspect of the new repayment plan is that if you're married, the spousal income can be excluded for the purposes of calculating the payment, as long as you're filing your taxes separately. But there is no protected income in this plan, and there's no adjustment for inflation as there is with repayment plans, the current repayment plans. There's also no cap on the WRAP plan, so that could make it a little bit more expensive down the line. It does offer forgiveness, but after 30 years under the current income-driven repayment plans, you can get forgiveness after 20 or 25 years. And it also is eligible for the Public Service Loan Forgiveness Program. If you're pursuing that, that's still going to be a 10-year path to forgiveness. So these are just some charts about what the new repayment plans may look like. This is, we would have to tailor this to your own circumstances. On the left is the new standard tiered fixed repayment plan. These numbers are based on an interest rate of 6.5%. It's going to change based on different interest rates, but you can get a feel for what the range of payments might look like depending on your debt size and how long you would have to pay it off. On the right would be the payments in the WRAP plan at different income levels. And this is based on somebody that has no dependents. If you do have dependents, these payments would go down a little bit. Okay, so one of the really important new rules under the new budget bill, it's the One Big Beautiful Bill Act, or OBBBA, state that all your loans must be paid back in the same repayment plan. And this applies to loans for students and to Parent Plus borrowers. And this is particularly meaningful for Parent Plus borrowers. So what it means is that if you take any new loan or consolidate an existing loan on or after July 1st of 2026, if you're a student borrower, then all your loans, including the older ones, must be paid back in either the WRAP plan or the standard repayment plan. So you will no longer have access to any of the current income-driven repayment plans or any of the current traditional plans, which come in all different forms and shapes. If you're a Parent Plus borrower and you do this, you take any new loan or consolidate an existing loan on or after July 1st of 2026, then all your loans, including any loan that was dispersed prior to that date, must be paid back in that standard tiered fixed repayment plan. So even if you consolidate your loans, Parent Plus loans are not going to be able to enroll in the WRAP plan. They're not going to have access to any income-driven repayment plans or forgiveness programs. So in order to pursue things like public service loan forgiveness or the longer-term forgiveness, which is called IDR forgiveness, you need to be in an IDR plan. That will no longer be an option for future Parent Plus borrowers. So this is a really important point to understand. If you're in the middle of borrowing for your children, or if you're thinking about starting borrowing as a Parent Plus borrower under the new regime, you need to be understanding that you're going to be relegated to this standard repayment plan. Your strategy is going to be only to pay the loan off, and you're going to need to make sure that you can afford those payments. Now, the one exception to this is if you have both student loans for yourself and Parent Plus loans, you can pay the student loans in the WRAP plan and the Parent Plus loans in the standard plan. So you will not be shut out of paying and pursuing forgiveness for your own student loans, but you will not have that option for Parent Plus loans. And then what we have is repayment options for what we're calling legacy borrowers. So a legacy borrower is someone who's done taking out their loans, essentially. So they're not going to take out any new loans, and they're not going to consolidate any existing loan on or after July 1st of 2026. So let's go over what the options are for those folks. So we're going to start with legacy student borrowers. These are people who have student loans for themselves. You're going to be able to access the current IDR plans, payee and ICR, under the current rules until July 1st of 2028, because those are being phased out under the new repayment bill, under the new budget bill. And you'll also be able to access something called another current income-driven repayment plan called income-based repayment. And as well as the new WRAP plan when that becomes available, which will be sometime July of this year. And you'll be able to access those plans. So you'll be able to access IBR or WRAP until your debt is forgiven or paid off. You'll be able to access payee and ICR under the current rules until they're phased out sometime around July of 2028. Now, the income-based repayment plan, or IBR plan, they have no income test. They used to have an income test. So if your income was high relative to your loan balance, you might not have been able to enroll in an IBR plan, but anybody with a direct loan or a FFELP loan can enroll in that plan now. But this plan also has a payment cap. So it's capped at no more than what you would pay in a standard 10-year fixed repayment plan. Payments are calculated at either 10 or 15% of discretionary income, and that depends on when the loans were dispersed. If your loans were dispersed on or after, if your first loans were dispersed on or after July 1st of 2014, but before July 1st of 2026, you're going to be eligible for the newer version of IBR, which is calculated at 10% of discretionary income. And that's got to, if you're pursuing forgiveness or just plain old IDR forgiveness in that plan, it's going to be a 20-year path to forgiveness. If any loan was dispersed before July 1st of 2014, the payment's going to be 15% of discretionary income, and it's a 25-year path to forgiveness. Now, if you're a Parent Plus borrower and you're done borrowing, so listen up, because this is really important for you. If you're done borrowing, you're not going to take out a new loan on or after July 1st of 2026. You have to make sure that your parent, if you have a direct Parent Plus loan that's not consolidated, it must be consolidated before July 1st of 2026 in order to retain access to income-driven repayment plans and forgiveness. So you will still be able to pursue forgiveness. You'll have access to a couple of income-driven repayment plans initially and the IBR plan eventually. But you must take this step if your loans are not already consolidated. And this is what we call a completion deadline, not a submission deadline. So that means that the entire consolidation process must be completed before July 1st of 2026, and that new consolidation loan be dispersed no later than June 30th of 2026. So what we're saying here is that if you're in this boat and you need to submit an application, you want to submit your applications no later than April 1st of this year. Now, April 1st is not a hard deadline, but it generally takes 4 to 6 weeks to complete a consolidation. So we want to allow for enough time for that to happen so that that loan is dispersed before June 30th of 2026. Now, once you're consolidated, you must enroll in the income contingent repayment plan, or the ICR plan, and make at least one payment. After that, you can then transition to the IBR plan, which is going to be around after July 1st of 2028, so that you can finish doing what you need to do to pursue whatever forgiveness program you're pursuing. Now, the enrolling in the ICR plan and making that one payment, that does not have to be done by July 1st. It just has to be done before they phase the ICR plan out, which is supposed to be somewhere around July 1st of 2028. But our recommendation, frankly, is if you're a Parent Plus borrower and you consolidate, you just make that payment in the ICR plan get it over with, and then transition to IBR. Now, in most cases, the majority of cases, IBR is going to be a cheaper option. If ICR happens to be a cheaper option for you, you might want to stay in it a little bit longer until you're required to transition to the IBR plan. Just making sure that everybody understands that that an older loan that's consolidated on or after July 1st of 2026 is going to be considered a new loan, and that's going to trigger these new rules and make all of your loans subject to more restrictive repayment options. And specifically for Parent Plus borrowers, it means that if you consolidate something later than July 1st of 2026, then all your loans have to be paid back in that standard plan. Okay. I'm going to just go through the other major rule changes, and I'll stop and see if there are any questions. So there are a couple other notable changes that I just want to bring to your attention. For loans that are dispersed on or after July 1st of 2027, those loans will no longer have any access to unemployment or economic hardship deferments. But I will mention that anybody that it would be eligible for an unemployment or economic hardship deferment will also be eligible for a very the lowest possible payment in the RAP plan, assuming that they're a student borrower and not a Parent Plus borrower. But the more significant impact is that if your loan is dispersed on or after July 1st of 2027, you can only request a period of 9 months of forbearance in any 2-year period. So right now you can request forbearances for up to 3 years over the life of a loan. That's not going to be the case going forward. So that's going to be one tool if you're struggling that's just going to be more limited to borrowers whose loans are dispersed on or after July 1st of 2027. Starting on July 1st of 2027, however, if you happen to go into default on your loans, there are several ways to eliminate a default or get out of the default. One of them is called loan rehabilitation. You can rehabilitate your loans. Right now, the rule is you can only rehabilitate a loan once. Starting July 1st of 2027, if you have a defaulted loan, you can use the rehabilitation tool twice to get yourself out of default. So that's actually a positive. Not that going into default is a positive, but at least it gives you more chances to get out of it. And then there's a couple of changes to a couple of different discharge programs, bar defense to repayment, which allows you to file a claim if you feel that and get your loans discharged if you feel that your school is guilty of some kind of fraudulent or activity or some kind of misconduct in advertising the pluses and minuses of the school. Biden during the and closed school discharge, by the way, would allow you to discharge your loans if your school program closes while you're enrolled or shortly after you withdraw. Biden era rules would have made these discharges easier for borrowers, but those Biden era rules are being deferred for 10 years now, and won't be put into place until July of 2035. Plus, also these rules are facing court challenges. So the Biden era version of these rules may never see the light of day. We just don't know it as yet. The BDR and the closed school discharge is still around, but they have to be assessed under older, more stringent rules at this point. Okay. So let me see if I can find the Q&A box while I'm actually having a little bit of trouble accessing the Q&A box. So if there are any questions and you want to unmute yourself, feel free to unmute yourself and just ask me. Okay. If there are no questions, I will continue. So I always like to talk about one of the services that we offer at EDCAP. When clients come to us, they frequently come to us because there is some immediate need that needs to be met, which of course is important. Either you're struggling, you can't make a payment, or or you are on the brink of default and you want to avoid default, you're in default, you want to get out of default. And of course, we're going to address the immediate needs. But one of the things that we always want to do, in addition to addressing your immediate needs, is leave you with a long-term strategy for eliminating your debt. Because after all, that is the whole goal here, is to get rid of this debt. So we have found, after working with thousands of borrowers since 2019, that most people are going to fall into one of three buckets. So that first bucket is pay your debt in full as quickly as possible. And this is going to really be a strategy that works well for people whose income is high in comparison to their debt balances. Maybe they can afford to make more than the required payments every month, or make lump sum payments. If this is your strategy, the faster you pay the debt, the more you're going to save overall over the life of the loan because you're paying less interest. So you may be making higher payments or big lump sum payments, but if it gets you to the end faster, you're saving money overall, if you can do it. The second strategy is where, frankly, most of our clients lie, which is you've got a relatively high loan balance and a low to moderate income. What you want to do is identify some kind of forgiveness program that works for you, that you're qualified for, and you make the minimum required payments until such time as you've achieved that forgiveness. So most of the time, this is going to require being enrolled in an income-driven repayment plan. Typically, when clients are pursuing this strategy, we don't advise making extra payments on your loans because in this strategy, your goal is not to pay the debt off. It's literally just to pay them the least amount that you have to pay to get that loan forgiveness. And then the last category, which sounds a little bit morose, but it's there for a reason, is to pay the minimum until death do you part. And the reason that we put this on here, and it's often a strategy for older borrowers who maybe took out late in life loans for themselves, or they have a lot of Parent Plus loans, but they're nearing or they're in retirement. So something like public service loan forgiveness isn't going to work for them, meaning that they know they're going to have to pay for at least 20, maybe 25, sometimes 30 years on the loans, which if you're 50, 60, 70 years old, that could be the rest of your life. The reason that we put it here is that, and the strategy, by the way, is to just find the cheapest repayment plan and make those payments until the end. But the reason that we put it here is because student loans, federal student loans, unlike other types of consumer debt, are dischargeable in death. So that means when the primary borrower dies, the burden of the debt does not pass to the spouse or to the estate or to the beneficiaries. It just goes away. And under the new budget bill, they've confirmed that death discharges are not taxable either. So if you're in this category, you just want to find the lowest payment, just make it, understanding that when you pass, it's not going to be a burden for your family. Okay. I do want to talk a little bit about some of the key forgiveness programs. So if you are a borrower that you know realistically doesn't feel like you're going to be able to pay your debt off the normal way, and you want to find a program that works for you, these are the main programs that you can go for. And I've alluded to these previously, but we'll go into it in a little bit more detail. So income-driven repayment forgiveness, or IDRF, that's going to forgive balances after you make 20 to 30 years of qualifying payments in one of these income-driven repayment plans. And that's IBR, Payee, ICR, or RAP. There's no employment requirement attached to this. And any credit that you may have accumulated, even credit that you may have accumulated in the SAVE plan, which is going away, or the Payee plan and the ICR plan, which will go away, those credits are going to be transferred to IBR or the RAP plan. So you're not going to lose the credit that you've already accumulated, which should hopefully make you feel a little bit better. There was a program called the IDR account adjustment that was during the Biden administration. It awarded retroactive credit towards IDR forgiveness based on a set of relaxed rules. Borrowers needed to have direct or Department of Education held loans by June 30th of 2024 to benefit from that. Right now, if you consolidate your loans, you're going to be resetting the qualifying payment count to 0 for this particular plan. or for this particular program. So again, this might be a situation where if you're not sure about what to do and you're not sure whether you have any of these credits, reach out to us for a one-on-one and we'll work through all of that with you and give you a one-on-one answer. Now, forgiven balances in the IDR forgiveness program may be taxable starting this year. So if your balance is forgiven in 2026, chances are it will be subject to at least federal income taxes. Although if you achieved your forgiveness in 2025 but didn't get it discharged until 2026, that should not be taxable, but we'll have to see, how that rule is executed later. And then, of course, there's public service loan forgiveness. If this is probably the best option for most people if you're eligible for it. In public service loan forgiveness, or PSLF, you make 120 qualifying monthly payments, so that's 10 years, after which the remaining loan balances are forgiven. And a qualifying payment is defined as an on-time payment made in full on or after October 1st of 2007. That's when the program started. So anything that you paid prior to that date would work towards paying the loan, but it's not going to count towards PSLF. You must have direct loans. You generally must be in an income-driven repayment plan, although payments in a standard 10-year fixed repayment plan count as well. But if you remain in the standard 10-year fixed plan for the life of the loan, then you will have paid the entire balance off in 10 years and there'll be nothing to forgive. And this program, of course, has an employment requirement. So you must work an average of at least 30 hours per week for one or more qualifying employers, and a qualifying employer is typically a nonprofit or a government. And if you have more than one job and you need those hours to add up to at least 30 hours per week, you need to be working them concurrently at the same time. Payments, however, do not need to be consecutive. So you can work in a PSLF qualifying job and accumulate 3 years of credit and then leave to go to the private sector and then come back a few years later. You will not lose the 3 years that you've already accumulated. Now, very important for anybody who might be near the 120 qualifying payments, at the time that you submit the form requesting forgiveness, so the form that will get you to 120 qualifying payments, you must be meeting the employment requirements. So you must be working an average of 30 hours per week for a qualifying employer when you submit that form. So if you are planning to, if you've met your 120 qualifying payments, if you plan to meet your 120 qualifying payments, as an example, in March, but you're going to retire in April, make sure once you make your March payment, you submit the application while you're still employed and then retire after that. Don't retire first and then submit the application, because you'll nix yourself out of forgiveness by doing it that way. There is a program called the PSLF buyback that was introduced during the Biden administration. It allows you to purchase months spent in a disqualifying payment status. That doesn't include school deferments, grace periods, or default, but it does include time that you might have spent in the save forbearance, which has not been counting towards PSLF. But this process is extremely slow. And right now, the time to clear the backlog that is piled up, some 86,500 applications, is estimated to be at 3.5 years. So if you're eligible for it, you should submit it, but we don't necessarily think you should rely on it solely to get yourself to PSLF. But if you do want to submit it, and if you are eligible for it, you can click on, you do that through the reconsideration portal. And it's relatively simple to do, and you can use the link in this deck when you get it. The extra good feature about public service loan forgiveness is that forgiven balances are not taxable at the federal or the state level in New York. So PSLF, whatever you're reading about tax bombs and other programs being taxable in 2026, that does not apply to PSLF. It's its own statute, its own law, and the rules are that it is not taxable. Now, if you are pursuing public service loan forgiveness, what you should continue to do is verify your employment. In order to get a qualifying payment count, you must submit what's called a PSLF certification form. That just verifies that you're meeting the employment requirements of the program, and you must have one form on record for every qualifying employer that you've had since October 1st of 2007 or later if your loans were dispersed after that date. You want to submit, there's no deadline for doing this, but you do have to have the forms on file. We generally recommend that you submit the forms annually or whenever you change jobs. And then we also strongly recommend that you do this by using the PSLF help tool, which is on your federal student aid account, and request an electronic signature from your employer. That's a thing now. It didn't used to be. You used to have to do this all manually. But the electronic signature has been around for over a year. And it's actually working really well. If you submit in this manner, you get a really quick update of your qualifying payment count. If you submit using a manual form, which you still can do, it may take months for them to process the application. Total and permanent disability discharge, or TPD. If you have some kind of a physical or mental disability or a chronic condition that prevents you from earning a livable wage, then you may be eligible for TPD. There are 3 different ways to get it. If you're a disabled veteran, if you're on SSDI, SSI, or SSR, potentially you might qualify. If neither of the first 2 works, you can get a medical professional if they're willing to sign a certification form, then you may be eligible. Now, they just changed the process by which people submit these applications, and I have to say it has not been without its problems and bugs. They seem to be starting to work their way out of it, but basically now you generally submit the applications from your federal student aid account. However, they can be submitted manually. If you need help with this, if you think you qualify, reach out to us and we can walk you through the process. All right, just some quick guidance for borrowers. So if you're pursuing PSLF or IDR forgiveness, so that, remember, IDR forgiveness is that longer term forgiveness. If you're enrolled in IBR or PayE or ICR, keeping making those payments to earn credit towards PSLF and IDR forgiveness credits. Borrowers who are in PayE or ICR who are going to need to make payments after July 1st of 2028 can transition to IBR or RAP if they're eligible for it. Generally, most people are going to be eligible for IBR as long as you're not borrowing additional debt after July 1st of 2026. For PSLF borrowers, as I was saying before, if you're eligible for the buyback, submit the buyback request, but don't rely on that alone to get you to 120 qualifying payments. If you're in the save forbearance and you're eligible for buyback now, chances are you probably only need maximum of about 18 months, but it could take 3 years to get that buyback request back. So our general recommendation is switch out of the save plan. If there's another IDR plan that you can afford, get into that IDR plan, start making those payments and earning credit towards PSLF, and see which strategy gets you there faster. Now, there are maybe some reasons to remain in the save forbearance until they eventually kick everybody out of it. It is temporary relief. If you can't afford any of the repayment plans right now, you don't have to get out of the save plan. It's just maybe going to give you a little bit more time to create a strategy. Switching repayment plans is going to require proof of income, which means that you're going to have to submit your most recent proof of income. If you're anticipating that your income is going to drop in the coming months, you might want to remain in the save plan so that when you submit the switch plan application, it's going to be based on a lower income. And by the way, if your income with these income-driven repayment plans, you have to recertify them annually. And if your income ever drops in between recertification dates, you can have the payments recalculated so that you don't have to wait and wind up making a payment based on an income that you no longer have. Also, if you're waiting for the RAP plan, if the new RAP plan is going to be your best option, you might want to just wait in the save forbearance until the RAP plan becomes available, starting July 1st of 2026, as long as the save forbearance doesn't end until RAP is available. But the longer we go, where the court isn't making hasn't approved the settlement, the more likely it is that you'll be able to wait until the wrap plan is available. Parent Plus borrowers, coming back to you. So if you're an existing or a legacy Parent Plus borrower, so remember, these are people you're done borrowing. You don't need to borrow anything on or after July 1st of 2026. If your loans are not consolidated, get them consolidated before July 1st of 2026. You must enroll in an IDR plan. Specifically, you must enroll in ICR, and make one payment before you switch to the modified income-based repayment plan, in order for you to have access to income-driven repayment plans going forward. But that payment does not have to be made, and the enrollment in ICR does not have to be done by July 1st. The key thing right now is if your loans are not consolidated, you must get them consolidated before July 1st. So submit that application no later than April 1st. Any Parent Plus loan, if you've got any loans that are going to be dispersed on or after July 1st of 2026, you'll no longer have access to the wrap plan or the modified version of the income-based repayment plan, and there'll be no path to forgiveness. So begin the consolidation and IDR enrollment now if you haven't already started. If you took new loans for spring of 2026, you want to consolidate those as soon as you can, those loans should be dispersed at this point. So you can consolidate them. You should be able to consolidate them now. If you have a defaulted Parent Plus loan, you can consolidate those loans to remove them from default, and that's probably the route that you want to go versus rehabilitation, which would take a lot longer, and then you would miss that consolidation deadline. If you're in that boat, we strongly recommend that you reach out to us for an appointment, so that we can address your needs. Now, if you're planning to borrow on or after July 1st of 2026 because your child is still in school and you're not done with the borrowing, just remember you're going to be locked into the standard plan if you do that for all of your federal debt. So this might require some strategy, and we very rarely tell people to go to and consider private loans. But as an example, let's say you paid 3 years for your child is 3 years through their schooling. You've got 3 years worth of Parent Plus loans. You yourself are pursuing public service loan forgiveness. If you want to preserve access to that forgiveness program for the bulk of your debt, you might want to consider taking out a private loan outside of the federal system to fund that last year so that you will be able to get forgiveness on your federal debt. Again, these are strategies that we can help talk through with you. And then finally, I'm going to say a quick word about delinquency and default. So a loan becomes delinquent after missing one payment. After 30 days, you're going to be assessed a late fee. After 90 days, the delinquencies will be reported to the credit agencies. And at 270 days, so that's 9 months, you're at risk of default. Basically, between 270 and 360 days, you are going to be probably in default at that point. So once in default, your debt is going to be payable in full and immediately, which of course is a non-starter for most people. You're going to have no access to the income-driven repayment plans, no access to forbearance, deferments, no credit towards forgiveness can be earned, and of course you will not be able to access federal aid if you're planning to go back to school. And of course, the big thing is that you would be at some point subject to involuntary collections. So the government has the ability to do an administrative wage garnishment. All these things that I'm going to talk about can be done without court orders. So they can garnish your wages up to 15% of your disposable pay. There's a floor that they have to leave you with, which equates to right now no less than $217 a week. They can intercept your tax refunds. They can offset your Social Security up to 15%. Again, there's a floor. They have to leave you with $750 a month. Now, involuntary collections are actually paused at this moment. So don't worry about it if you're in the middle of tax season and you've got a defaulted federal debt. If it's held by the default resolution group, you're not going to have to worry about a tax refund intercept just yet. But we will generally argue that if you're, despite the fact that there is a moratorium on collections, including wage garnishment, tax refund intercepts, and Social Security offsets, that you should probably work on getting your loans out of default now because we don't know when they're going to restart collections. Based on what they said, we're assuming they will start no earlier than July of this year, maybe even later. But you never know. And they've announced starts and then clawed them back and announced them again. Last time they said that they were going to start, they gave people about a month's notice. So it can take time to get out of default. So if you're in default, you might want to start working on getting yourself out now so that you're not going to be subject to these involuntary collections whenever they do resume. Um, there are two ways to get out of default. One is by consolidating your loan, which just basically means that you replace an existing loan with that's in default with a new loan that's in good standing, and you start making payments on that new loan under new terms. Or a loan rehabilitation, which preserves your existing loans, um, and you make 9 agreed upon payments over a 10-month period on time and in full, after which your loans are taken out of default. So the consolidation is a lot quicker than rehabilitation, but there are pluses and minuses. I'm not going to go over them all here. I think if you're in default, you probably need to reach out for one-on-one counseling so that we can figure out what the best route is for you. And not everybody is eligible for one or both of these options. Okay. And then finally, if you need to contact us, we have our contact information here. You can either call our helpline, you can email us, or you can book an appointment online. If you're struggling to get an appointment online and you need something sooner than what's available, call the helpline and we'll try to accommodate you. So I'm going to stop the presentation. I know that was a tremendous amount of information that I gave you, and I hope I didn't give you a headache with all of that. But since we have a few minutes, if anybody does have a question, feel free to raise your hand and I will unmute you. Okay, well, I do not see any questions. Let me just, oh, somebody does have a question. Okay, go ahead, David.
Hello.
Hi.
So I currently don't have any loans, but I'm looking into loans. Is there a webinar or somewhere that you guys have where I can look, or at least just ask? Because it's not yet, but it's gonna be soon.
Right. Well,
Like,
actually, I believe we're doing a webinar tomorrow night also through these assembly members that is going to address sort of funding higher education and the FAFSA process. Um, Evelyn, I'm not wrong. It's tomorrow, correct?
Yes, it's tomorrow at 6:30 as well.
Okay. So yeah, you can go to our website and sign up for that. It's the website is edcapny.org. And just go to where it says attend a webinar and you should be able to, I think it's listed there. Actually, it may not be listed there. We'll make sure that we get you the information, okay?
okay, okay, sounds good. Thank you.
Anybody else? Okay, I don't see any other hands up. And I was actually just gonna double check the Q&A box. And I don't see any questions in the Q&A box. So I'm going to wish everybody a good evening. And like I said, feel free to reach out to us for a one-on-one because this is a lot to consume in one evening. So have a good night, everybody.
Good night.